Thank you for sponsoring. And if you guys want to put on speaker view, then you'll see the big, just the speaker view instead of all these little boxes that are muted. All right, Jeff, I'm turning over to you.
Great, thank you, Debbie Lee, and thank you everyone for joining. I'm sure like me, all of you would rather be in person meeting, but of course, unusual times. So I think we've all probably gotten used to these Zoom meetings and how they work. So appreciate you taking some time this morning. I'll share my screen here in a minute, but first I want to introduce myself and our firm to you. We're rather new to the Columbus market and the FPA, but I've been with the FPA in the Indianapolis market for 10 to 15 years now, and just love the relationships that we've developed over the years and the people and really the mission of the FPA as a whole. So really looking forward to continue to meet new people and develop new relationships. As Debbie Lee said, my name is Jeff Hess. I'm with the Palladium Group, an organization that's under the umbrella of Ash Brokerage. I'll get more into that, a little bit about me, because I think it helps tell the story of our mission as a firm. I started back in this industry 21 years ago and came into it in the insurance space, wanting to follow the path of becoming a financial advisor and selling long-term care insurance. I'm still amazed to this day that I could cold call, schedule an appointment, and go out and meet and sell a long-term care insurance policy to folks who were in their late 50s, early 60s. While I still believe that what I did was great and helpful and beneficial and good planning for the clients, about 5 to 6 years into my career, I realized that even though I was moving into financial planning and retirement planning and things like that, it's still the approach of selling an insurance product to a client without really doing proper planning was no longer appealing to me. And so at that point, I made a career shift and joined Ash Brokerage. The first half of my career at Ash, I was really involved in analyzing and reviewing existing in-force life insurance policies. During my time in the first half of my career, it was eye-opening to see what was taking place in the insurance industry that I was not previously aware of. How many policies were sold and truly not done proper planning. And I think you've all probably experienced some aspect of it, that insurance oftentimes is sold and not necessarily recommended in the appropriate manner. What I also found is that policies were not managed and did not meet the expectations that were set. So maybe they were underperforming, maybe they were sold incorrectly, or they simply, as I said, were not managed. And while insurance doesn't move drastically like we've seen the markets move, they still need to be managed and monitored and properly, which goes to really the third reason of what was eye-opening, and that is they weren't considered part of the financial plan, or at least not managed and reviewed as part of the financial plan. I don't know how many times I talk to folks who have had policies for 15 or 20 years and they don't recall why they purchased it, but now they know that it no longer fits the needs and goals of their financial plan. And so it's just not a piece of the planning process like it should be in like other financial instruments. And so that really sort of drove my mission in the insurance space. And it was about 2011, 2012, an advisor I'd worked with for many years approached me and said, and it was now with a fee-only RIA in the Indianapolis market. And he approached me and he said, "Hey, Jeff, like here's what I'm doing now, and here's how we operate, or here's how we incorporate insurance into our practice with our clients. And we have 6 or 7 different insurance professionals. The process is all different. Their deliverables are all different. The expertise varies across the board. Some of these advisors are now moving into financial planning and investment management. And while we believe in what we do, we recognize there's still a threat to the insurance professional taking our client with them. So all of these things, essentially he said to me, Jeff, our process is broken. Can you just work with us directly and be our trusted insurance consultant? So I said, sure, Mike, help me figure it out. And so he really brought me up to speed on what is a fee-only RIA, what is an RIA to begin with, how does fee-only differ from fee-based, and how is that different from the rest of the revenue-oriented insurance and financial advisory space. And so the beauty of what I believe we bring to the market in the Palladium Group is we were developed not only for, but by a fee-only RIA, and they helped us really develop and build our story. And so I'm gonna get into, my, everybody see the screen? Ron, I see you on there. Can you see the screen?
Yes. Mm-hmm.
Okay. All right. So the Palladium Group, we're a boutique insurance consulting firm, as I had mentioned, as a part of Ash Brokerage. So we consult and advise your clients along with you in the insurance world, disability, long-term care, and annuities. As part of this process, there's a lot of talk around the fiduciary process in today's world, and the insurance industry has really had a hard time adapting to it and understanding what that means. And that is our focus, is to really become, we can't call ourselves a fiduciary, but we can act in a fiduciary manner. And so we're very focused on aligning our process with yours, being outcome oriented, and providing the same level of expertise and proactive, consistent communication that you all provide. The last thing that we want is for an introduction or referral to a client of yours experience to drop then and become what they're used to in the insurance space and sort of this clunky process. We have access to 80 different companies across the industry amongst, again, life, disability, long-term care, and annuities. And so our goal is to really mirror what you do, how you do it, achieve that similar excellence and similar experience in the market. Yes, we're a smaller firm, smaller division within Ash Brokerage, which helps us to be nimble and make quick decisions and really customize things for you guys as firms, as advisors, because you're all different in how you work with your clients. But we're backed by the history, 50 years of history of Ash Brokerage, over 400 colleagues across the country in different spaces that I can call in, from advanced planning, estate liquidity, business succession planning, disability income, all across the board. So it gives us the ability to be small and nimble, but have that depth of expertise. As I mentioned, and I can't stress it enough, we really believe strongly in mirroring your fiduciary duty. It's not just about having the proper credentials or aligning your fee structure in the same way, but it's a mentality. I believe it's a mentality to be a fiduciary and make sure that what you're doing is solely focused on the client and in their best interest. So we collaborate with you to make sure we're aligning everything throughout the planning process, and we're solely focused on insurance. So we don't gather assets, manage money, or compete for client control. We recognize that you are the key part of the relationship, the key driver of the relationship. Question we always get, because there's a lot of talk about low load or commission-free insurance solutions, a lot of marketing terms that are out there. As I mentioned, we have 80 different companies that we have access to, ranging that their compensation model ranges from a low load, low commission product to fully retail commission. There is no fee to access our platform, so our revenue is driven off the commission. I don't get paid a commission off of an insurance product that is implemented. The revenue goes to Palladium Group as a firm. So we try to remove ourselves from any type of conflict of interest by this compensation model. I'll wrap up here in a couple minutes, or in a minute, because I know we're running short on time.
Yeah.
But what I want to drive home is it's not just about advising and consulting up front and implementing, but it's taking the client from start to finish, the application process, providing ongoing monitoring and maintenance, and providing monthly data feeds and reporting to you as advisors and to your clients. So it's a long-term relationship and not just an implementation. Again, really going back to a financial planning process and making sure we align ourselves with your fiduciary duty as advisors. So I want to thank you for your time. Enjoy the rest of your day. Thank you, Debbie Lee, and I'll turn it back over to you.
Thank you. All right. And then if you stop sharing your screen, that's awesome. I just, another thing is if you have any questions, type them in the chat box and we will get to them at the end of the presentation. If you notice on the agenda, we left, you know, after we end at 10:15, we'll leave a few minutes for questions. So type those in the chat box. They will not get answered until the end, just so that we can keep going. And for any of you that are joining us late, just if you're getting insurance information, answer the poll questions. I'm not really sure if you're joining via phone. Reach out to me via email because I'm not sure how you can get credit because you're unable to see the poll questions. I'm hoping those are just people calling in that don't have microphone, in which case, and you're just listening on your phone, that's fine. So watch for the poll questions, answer them, even if you're not insurance. If you answer them, they're just some things I want to know anyway. And with that, and without further ado, I will hand it over to our speaker, Ron Mooney. And thanks to Jeff Haas also for partnering with us and sponsoring. And to you, Ron Mooney, I'm out. Thank you.
Good morning, everyone. My name is Ron Mooney. I'm with the RHK Group. I'm not sure how I get mine on there, but at any rate, we are an independent agency and consulting firm located in Dublin, Ohio. And I had the pleasure of speaking with you guys about 2 or 3 years ago. And I really appreciate the opportunity to come back and present this information today. I wish I could be there in person. I'm sure you guys all do too. But we're living in a pretty extraordinary world right now. And so we have to learn to adapt and obviously embrace Zoom. So we just have to kind of make do with what we have. So I am going to share my screen here and get into my presentation. Hopefully I can. Okay. Hopefully you can all see this. Debbie, can you just confirm that you can see the screen?
I do not see it yet. I think you have to hit start sharing and then it'll work.
I thought I did, but it didn't click on. Okay.
Is it clicked on what you want to share?
Okay.
There you go.
That better?
I see it. Yep.
Okay.
Got it. Yep. And then you can start the slideshow and that's what we should see.
Okay. Great.
Perfect.
So I'm going to go back just to the title page here really quickly. As you can see, we're going to be talking today about MEWA'S, and that is an acronym for Multiple Employer Welfare Arrangement. And so I didn't really want to put all that on the first screen. I used that acronym, which is pretty helpful. And we're going to be talking about those and other health insurance alternatives for small groups. So I'm hoping that you find this information interesting and useful. I know that you probably work with small business owners on a regular basis, and I can pretty much guarantee you that insurance is one of the things that is a pain point for them many times. So it's an expensive proposition to provide insurance for themselves and employees. It's confusing, and a lot of times it appears that there just aren't very many options out there. So hopefully you gain something by this. You might be able to maybe point a client in a little bit different direction, or at least have them think about looking at different alternatives that might be able to help them into a situation that might save them some money and provide better coverage. So I'm going to talk first about the Affordable Care Act. I'm going to spend just a very brief amount of time on that, but it seems like everything kind of stems from the Affordable Care Act. It's affected everything that we do today. We're going to particularly look at the effect of the Affordable Care Act on small group plans and see how it has impacted that market. And then we'll get into the two options that I'm going to cover today that have become pretty popular. First are these what are called self-funded or level-funded plans for small groups. And then we'll get into the topic that I'm going to spend the most time on, and that would be the multiple employer welfare agreements, or MEWA'S. And then we'll have the questions, as Debbie mentioned. I will say that with questions, I know that these formats are not always conducive for questions, and of course we may run out of time too. My contact information will be at the end of this presentation, and I do encourage you, if you have anything at all that you want to review in more detail, or you just have another question you didn't think about, please feel free to call me. I'm very open to that. I always will give you as much information as I possibly can if it helps you in your endeavors. So let's talk about the Affordable Care Act first. Kind of incredibly, this is the Affordable Care Act is celebrating its 10-year anniversary. It was actually enacted in March of 2010, and I'm not going to go into the entire Affordable Care Act, but I will talk about one aspect of it, and that is that it did take a look at group business and divide it into two different segments. And so the first segment that they looked at are large group employers. So employers that have over 50 employees. Started out as 100 employees, they reduced it down to 50. And this large group market, in my opinion at least, was not affected too much by the Affordable Care Act, at least from an underwriting and market access standpoint. So we still kind of handle those groups in the same exact way, gather underwriting information. We still have the same companies that we can go to. The rating methodology is pretty much the same as it always has been. A couple of things that impacted that segment. Employers were forced to offer this affordable coverage, and they had to supply minimum essential benefits for employers, and for employees, and if they didn't, they had to pay a penalty of up to $3,000 per employee per year. So there was a little penalty in there if they didn't fulfill their obligation to at least offer coverage to people. The other big thing on the large group side is that they put a lot of reporting requirements on larger groups. And that was pretty chaotic at the beginning of this whole process, but at this point in time, most of the groups have automated all of these reporting requirements, and really is not that much of a big deal for them anymore. Still, it's cumbersome and there's an expense associated with it, but again, the large group market has continued to operate pretty much the same as it always has. The individual and small group segments were affected much more. And so I'm not going to talk much about the individual side, but the big thing on individual was of course the individual mandate. That was one of the large things where if you did not secure individual coverage or get it from your employer or some other manner, then you could actually face a penalty in the way of a tax penalty that the IRS levied on you. That was all repealed in 2018, effective the 2019 plan year, or tax year rather. And so that pretty much went away. But the other thing that affected both of these markets was something called community rating. And community rating is a methodology that was applied to all new individual and small group plans. And so I'm going to dig into that just a little bit more. So this community rating, and this may ring a bell, you may not recognize the word at first, but when you see these four metal themes, it probably will come back to you. Community rating kind of separated medical plans into these four categories. So bronze, silver, gold, and platinum. And as you go up that ladder, starting with bronze, going up to platinum, every time you go up a category, you're going to a plan that's a little bit richer and a little bit more expensive. So the bronze is really the plans that offer, they offer minimum essential coverage, but it really is something where you can have a lot of out-of-pocket expense. There are a lot of exposure for the people that go on those plans, but it is the most affordable. You get up to silver, a little better coverage, more money. Gold, same thing, keeps on going up just like that. The thing about all these community rated plans is that there is no underwriting associated when a group goes to these plans. So there are no medical questions whatsoever. They don't take into account any pre-existing exclusions or any conditions that are out there. So really, they don't take a look at the health of the group at all. The rates are solely determined by zip code, by age, and by smoker status. And so that's really how you get a group. So If you step back and think about that for a second, you could have two groups that are sitting in the same office building, and they each happen to have, let's say, 5 employees. And coincidentally, those 5 employees all are exactly the same age, and they all are non-smokers. Let's go all the way down to that. One of the groups is totally healthy, really nothing going on from a medical standpoint. The other group has a couple of people with chronic illnesses that are very expensive to treat. Those two groups go into this community rating program and get the exact same rate. So that's how it works. So when you think about that, you have all these groups coming in, they're all getting the same rate. That would only make sense that the premium levels are set at a very high level to enter the program. That's because they don't know who's going to come. It could be they get 90% of the groups have pretty serious health conditions and only 10 are healthy. They just can never tell. So those rates for those programs are very, very high in the community rated world. And I just have this chart here just to give you a quick overview of kind of average costs in Ohio for community rated plans. And you'll see that we've got that bronze, silver, and gold tiers in there. There are a couple of others that were added later. Catastrophic is another plan level. Basically, they found that a lot of younger people that were healthy and really didn't need all that coverage, they kind of opened up another category for that had even less coverage than the bronze policies did. And then this expanded bronze is really just another category that's kind of evolved, that just kind of added another step in there where people could get a few more bells and whistles. But if you take a look at those bronze, silver, and gold categories, you can see that the bronze world is pretty expensive, high 700s per month per person. You get to a silver plan, you're up over 1,000, and you get to a gold plan, you're up over 1,200. You don't see platinum on there, and that's really because I don't know of any carriers out there right now that even offer a platinum plan. I believe that they found that those were very rich in benefits, but also so expensive that they just weren't selling them. So we just don't get a lot of information on those, don't even see them in the marketplace. But bottom line is these community rated plans are very expensive. So that's the thing I just wanted to impart to everybody. So this Affordable Care Act gets sent out there. What happens to the small group market? All right, so if you take a look at this legislation, hold on here, I've got the poll question up so I couldn't see my screen, but sorry, the effect here, first of all, the legislation.
Ron, don't say that.
I'm sorry. I'm sorry about that, Debbie. All right, okay. So the legislation was originally slated for all group plans with less than 50 employees. They were really going to be forced to migrate to community rated plans. So that was the original intention. Everybody had to go to a community rated plan. There were going to be no more normal small group plans in the marketplace. And then President Obama, in part of the negotiations and part of the lobbying for the Affordable Care Act, was on TV and said this kind of famous line in bullet point 2, said, hey, if you like your health care plan, you'll be able to keep your health care plan. And so obviously politicians on both sides latched onto that, and so did consumers. And so there were some concessions that were made that allowed insurance companies to continue offering these, what they gave a label for it. They call them grandmothered plans. And essentially a grandmothered plan is nothing more than the plan you had before the Affordable Care Act was enacted. So really just a continuation of the coverage you've always had. So they said, okay, we're going to allow you to continue to do that. And they kind of pushed the transition date down the line and said that in 2014, that's when everybody's going to have to migrate over to the community rated plans. Well, as it got closer to 2014, they decided to extend the deadline. And actually that deadline has been extended 6 times in total. And so right now the new deadline is October of 2020. I fully expect that deadline to be extended as well. They're just busy dealing with obviously the coronavirus, and there's some election things, but I am virtually certain that this will get kicked down the road again, and we're not going to have to worry about this deadline for groups to migrate over. So because of this, what happened then? So the small group market, essentially all of the existing small group plans, they kept their grandmother coverage. Most of them stayed right where they were because the alternative was going to be a very expensive community rated plan. For newly formed groups, so employers just entering the marketplace or just getting out to start a brand new plan for whatever reason, their only option for a long time was the Affordable Care Act community rated plans. And so for new groups, they were looking at very expensive coverage. The groups had to have at least 2 members to establish a group. So if you had that sole proprietor that was out there or a single member LLC, they were not able to get coverage in the group world. They would have to go to the exchange and get individual coverage. A lot of the community rated programs had network issues. So a lot of these companies were trying to operate on very tiny networks. And so people couldn't see all the doctors that they wanted to see or go to the hospitals that might be near them. And then, of course, the benefit issues, it was so expensive that most groups were kind of gravitating towards bronze plans, which had very high out-of-pocket costs for employees. So, really not a great option for all these new groups that sprung up. So the insurance marketplace being what it is, a lot of insurance companies started to get creative and take a look at other options that they could offer the small group market. And one of the first things that came up are these self-insured plans for small groups. Now, this is really not a new concept. These have been around for a while, but they were primarily geared towards groups that would have really at least 25 employees and probably more common to be in the 40 to 50 employee range. But insurance companies said, hey, let's take a look at these and try to expand them. So several new insurance carriers came in and started to offer these self-funded plans. And then you're also going to hear the term level funded plans. They're identified as both. And so United Healthcare came into the mix, Aetna got into it in a big way, and National General. Those are 3 of the bigger carriers that offer these in the state of Ohio. These plans are subject to federal ERISA rules. So by going under the federal rules, they could avoid all of the community rated programs. So they can be medically underwritten. There's no community rating. So they escape all of that stuff that was really causing angst in the marketplace. And a lot of these companies started to reduce the number of employees you could have to qualify. And now you can get a group with as few as 5 employees to qualify for one of these plans. So how does the plan work? So they are self-funded. They are on a self-funded platform. And I'm not going to get into a whole lot of depth on self-funding. It would take me an hour or 2 just to really get into all the nuts and bolts of self-funding. So I'm going to keep it at a very high level. But essentially in the self-funded platform, you really have 2 major buckets of costs. So things that make up the premium for a self-funded group. So that first bucket is the fixed costs. And under fixed costs, there are 2 main categories. First are administrative fees. So the administration fees are really paid to the insurance carrier, and that's their fee to handle all the claims, adjudicate all the claims, make sure they're paid properly, and all of the other aspects of plan management. So producing plan booklets and documents, ID cards, giving members access to their websites, and all of the resources that they bring to bear. So there's an administrative fee, and that fee is set on a per employee per month basis. So same exact fee every month for every employee that does enroll in the plan. Second big fixed cost is stop loss coverage. And so stop loss coverage is sitting out there as a catastrophic catch-all for claims that are very large. So the stop loss coverage essentially would say, hey, we're going to pick up on the stop loss side any claims for people, members on your group that have claims over $30,000 in a given year. That would move over to the stop loss side. The employer is not technically charged with those claims. So that's another major fee that goes into the premium. Again, it's fixed. The way this works, usually there's a set charge. If an employee enrolls with no dependents, there's a set charge for that type of enrollment. And then when an employee enrolls with any dependents at all, usually it's another level of obviously more expensive cost for that type of enrollment. But at any rate, when you get the final enrollment, those two numbers, the administrative fee and the stop loss fees, are fixed for those people for the entire year. The second set of costs that go into the bucket is the claim liability. And so there's a claim funding account that's held by the carrier, and they use the money that goes into that claim fund to pay for claims for all group members. Okay, and essentially those are the two components. And the employer pays a set premium. So the insurance company goes out there and says, okay, we've got your enrollment. We are charging this much for administration for these people, this much for for the stop loss premium. And then this is the claim liability that we're charging for each person individually. And then they give you the total claim pot of money that'll be collected over the year. They give you an idea of what that all is. And they set that claim liability at the maximum possible liability it can be. And so there's a protection in there, and they say, okay, this is your worst case scenario. This is the highest that we could ever charge you for premiums. And so they set the premium at that worst case scenario level. And then the employer gets these monthly claim reports every month to go throughout the year, and they can go ahead and kind of gauge where they are from a claim standpoint. So they know what their claim pot is supposed to look like. They know how much they've paid year to date, and they can get a good idea of whether they've used, whether they're going to likely use all that money or not. So I know that's a very high level explanation, but I'll hopefully be able to explain it a little bit better in the next couple of screens. So two things can happen. So first, the group claim experience comes in at less than what the maximum claim liability was set at. So there's a pot of money out there that was not used. If that's the case, the carrier returns a portion of the savings. Sometimes they return all the savings, just depends on the carrier. So the employer actually gets to get some of that money back that wasn't used. The caveat to it is the group must renew with the carrier. So you have to renew the plan to get that credit back. It's not calculated or paid until at least 90 days after the policy period. And usually that refund is applied to future administration fees. So it'll sit out there and just go against any cost that you have for either administration fees or even stop loss fees. It could go against that if the credit's large enough. So you have a chance to win. You have a chance to get money back if your claim experience is good. If your claim experience is poor and your claims are higher than that maximum premium that the carriers charged you, you have no additional liability. So you've paid the premium, you're done. They might have paid $2 million in claims over the year, and you've only paid them $1 million. You have no further liability. You've paid the maximum, you are done. You could technically walk away from the plan if you wanted to and have nothing else to owe. So you don't owe anything, but that poor claim experience will probably yield a higher premium once that renewal comes around. And so you may or may not decide to stay with that premium increase, but again, you walk away and you're done. You've paid exactly what you owed. So to put it into a little bit of a graph form, which I think will help explain this a little better, if you take a look, it's really simple. If you take a look at that blue bar on the right-hand side, that's what a fully insured plan will look like. So 100% non-refundable premium, you give that to the insurance carrier, and it is a pure transfer of risk. So you say, here's this pot of money, and you're going to cover all our claims, whatever they are. And even if we don't use all that money, you're not giving me any back. If we use more than that, that's you're tough luck. You didn't set the premiums at the right level. On the level funding side, they set that premium. It could be the exact same premium that's in that blue bar. That's kind of the example you see here. But the premium is, again, broken down into categories. So much of your premium is really identified as administrative expenses. You know how much is being put towards that fee. You know how much is going towards stop loss. Those are your fixed costs that we just talked about. The orange box and the white box, that's that claim pool. And so that's the money that's at risk. And you can see in this example, the orange box was the actual claims that were paid, and that white box would represent the potential savings. So if a group actually had this type of year, they would get that savings back as a premium refund. So they might have started out paying the exact amount as a fully insured plan, but they get money back at the end of the year because they had a good year. Okay, so again, I won't spend a lot of time on this, but I do want to go a little bit of summary on these self-insured plans because they can be very valuable, and we do have a lot of groups that take advantage of these. So really the first thing to remember, they have to have at least 5 employees. This isn't for the very small employer. Some of the companies will require they have at least 10 employees. So, you know, the market it really is geared towards a little bit larger business. Younger, healthy groups are typically going to yield a better result. So they're more predictable, they're younger, they're not potentially using all of that claim pool. And so you just have a better chance of getting money back at the end of the year. So when we see that younger, healthy group, we know that they might be a good candidate for these. We also see a lot of grandmothered plans that come into this world as well. So you think about that, geez, they've had this plan with a carrier for the last 10 years. So they stayed in there with their grandmothered plan that they had before the Affordable Care Act. During that 10-year span, they might have had a couple of years that were, you know, maybe minimal rate increase situations, but chances are they had a few years that were in that 10 to 20% rate increase range as well. And so over time, their rates have increased fairly dramatically from what they were 10 years ago. And sometimes if you take a look at the dynamics of the group, it may have changed. Maybe they had a couple of people with chronic illnesses that are no longer on the plan. So they might have a different rate today, or might have some brand new company looked at them. Maybe they had a couple of older people who retired and they were replaced by younger employees. That could change their whole situation. And sometimes these plans might work much better for a grandmother plan that's, you know, kind of stuck with the plan they've been with for a long time. The biggest thing is this is a strategy to avoid that community rating world. And so in most cases, unless a group is extremely unhealthy, these rates are going to come in much better than community rated plans would. We know what the maximum employer liability is. It's defined right up front. So you know that that's your worst case scenario. You kind of look at that as your premium. And then you get to look at all the claim data that comes in. That's the one problem with small groups. You know, they get a renewal from their insurance carrier and they say, geez, why did my premium go up so much? And the carrier doesn't share any of that claim information. And they get a lot of gray answers like, well, it's your experience plus what the marketplace is doing, plus what our results were as a company. I mean, they don't give you any detail. With these types of plans, you see exactly where your claims are. You can kind of tell before the end of the year whether you're going to have a big rate increase or a small one because it's sitting right in front of you. But then there's an opportunity to get that refund as long as you renew with that carrier. So they're great options for smaller groups that I think really have their place in the market. And again, we use these quite a bit for some of the groups that we work with. So the other big option for small groups, and this is something that's evolved in a big way over the past 5 years, these multiple employer welfare arrangements. And again, that acronym of MEWA. And so I'm going to take a quick look at these. First of all, they've been around for a very long time. The whole MEWA concept has been there, I'm not sure the exact time frame, but for years, both at the federal and state level. So at the federal level, basically, the ERISA laws allow them to exist. So they have a provision in the ERISA regulations that basically say, yeah, you can have these MEWA arrangements where multiple employers can come together to buy coverage. So it sits out there, and then after that, all of these plans are regulated by state law. So they allow the plans to exist, but the states get to dictate how they are formed and how they comply with the laws of the individual states. So in Ohio, for a long, long time, it was Chapter 1739 of the Ohio Revised Code. That really dictated how a MEWA could be formed. and what the rules were for them operating in the state of Ohio. So MEWA essentially is, again, a big concept is allowing small employers to band together to purchase insurance coverage as part of a large affiliated group. And I've got that affiliated underlined because it's a critical definition that allows these groups to come together. It has to be an affiliated reason. And so in the state of Ohio, the law had set up until recently that it was strictly limited to professional and trade associations. So three of the big ones that were out there, the MEWAs that were formed, the Ohio Medical Association, the Ohio Dental Association, and the Ohio Builders Exchange. So you think about that, all the doctors got together and they could have their own medical plan through their association. All the dentists got together, and on the building side, all the contractors and construction trades were able to get together and buy health insurance as a group. So really had to have that professional or trade tie in the state of Ohio. Now, again, these plans are all structured on a self-funded plan design. So not much different than what we just talked about a few minutes ago. But in this case, instead of the insurance company kind of being that the one that accepts all the risk, here the MEWA is actually financially responsible ultimately for the plan. So the MEWA itself is collecting the premium from the employer members, and they are responsible for paying all of the claims. Now, they do purchase that stop loss insurance to make sure they're protecting against the really catastrophic losses. So that they'd have to do that, or else they'd be in situations where they could certainly face bankruptcy very quickly. So they cede off some of the real tough stuff to stop loss insurance, but all of the rest of the claims are the responsibility of the MEWA. They usually and almost always hire a third-party administrator to manage those claims. So that third-party administrator would do all the blocking and tackling, make sure the claims are adjudicated correctly, make sure that the member pays what they're supposed to pay. The MEWA would pay the rest, and then if it hits certain levels, the stop loss insurance carrier would have to get involved, and they would pay anything that was catastrophic in nature. Third-party administrator also would produce plan documents and ID cards and run all those functions as well. So truly a self-funded plan design. So what happened in Ohio over the past several years? Results were not really great. So first, there was not a whole lot of regulation in place, and specifically in regards to insurance reserves. So didn't really monitor the reserves that were being put aside by these MEWAs to make sure that they remain solvent. Some of the MEWAs started out providing rates that were substantially below what the Ohio Department of Insurance would have regulated them to be. And so they were obviously trying to attract members, give their members a good deal. So they were probably underpricing the product. So that led to some severe financial hardships. They weren't collecting enough money. They weren't doing a very good job of underwriting their book of business. So not pricing for the risk that was coming in. There was situations where there were some mismanaged funds. And of course, the inadequate reserves I've already mentioned. A lot of these things caused some real problems for some of these MEWAs over the years. And many were forced to take dramatic rate increases. And so in the insurance world, when that happens, when companies take dramatic rate increases, we have a phenomenon called the adverse selection. So essentially, in this situation, a lot of the healthy groups, their rates got to a point where they could find coverage elsewhere cheaper, and they left the plan. Some of the groups that were not quite as healthy, those rates were probably as good as they could find, but the whole pool of business became more skewed towards unhealthy people, and that just caused further problems for them and more rate increases and kind of a bad spiral that they get into. And so a lot of times these poor results really ended up with the MEWAs having a buyer beware reputation. So really didn't have a great reputation as time went on, just because of the way they kind of operated in some of the predicaments they found themselves in. So that kind of changed when we got to 2015. So there was some lobbying by industry groups and some of the insurance carriers. And there was this Ohio House Bill 64 that was signed into law in June of 2015, and really attempted to expand the MEWA program and put a lot more regulation around it. So the expansion was basically allowing more affiliated groups to be allowed into the MEWA world. So for instance, chambers of commerce were allowed to form their own MEWAs. Other more loosely held associations, so they didn't have to be made up of all the same profession, like doctors or stuff like that. They started to just expand the definition. They did still have the caveat that you couldn't form an association solely for the purpose of buying health insurance. There had to be another reason for those association or chamber members to be coming together. It had to be another business purpose. And they also made sure that they weren't just established and not financially stable, and they didn't have some kind of track record. So there's a vetting process that goes on, but they did expand the ability for these other entities to come in and be eligible to establish a MEWA. One of the big things they did was increase the required minimum surplus. So to even come to the table, if you had the idea that, hey, my chamber or my association wants to start their own MEWA, you had to bring $500,000 to the table that was set aside as a reserve. And then as you start to write premium, that reserve goes up. So it's commensurate with how much business you have on the books, and that's all strictly regulated. The Department of Insurance also tightened up the reporting requirements. So the ODI comes in every quarter to these MEWAs and does a full audit. So they look at every single aspect of the financial health of the MEWAs to make sure that they are stable and solvent. And then they also require the MEWAs to run their rates by them annually. So they make sure that there is an actuarial soundness to the rating methodology, that the rates that are going out to the group members, and they won't allow them to underprice their product and accept risk without getting the proper premium. So that bill really did a lot to shore up the MEWA world in Ohio. And so this expanded legislation, coupled with the ACA problems, the marketplace restrictions, it led to the creation of several new MEWA options for small groups. So we're going to talk about that. I'm going to talk about these markets that have become available over the past 5 years. There are 3 real major new MEWA markets. And basically what has happened is these associations or chambers of commerce have partnered with insurance carriers to create the new programs. So there is a strong partnership. The MEWA is saying to essentially, hey, we don't know everything about this insurance world. We want to start this. We think it'd be great for our members. So we're going to go ahead and partner with an insurance carrier that has the expertise to do this right. So those partnerships were formed. They're all self-funded plans. And so that's the MEWA structure. They're all financially backed ultimately by the association or the chamber that sponsors the MEWA. The member group rates, so the member group rates are set at the beginning of the year, and they're all based on the group characteristics. So they take a look at all of the factors, the underwriting, the health conditions, age of the group, all of those things. They set a rate for that group for the year, and they're guaranteed for 1 policy period. So at the end of that policy period, they'll take a look at how the group did in relationship to premium collected versus claims paid. And that group will be looking at a rate increase or possibly a flat renewal. I've seen a few rate decreases even in my history with some of these. So they really go ahead and the MEWA takes the financial risk, but they set the rates on a guaranteed basis for all their member groups. The insurance carriers play a big part in this. So they basically administer all aspects of the plan. So they handle the initial underwriting and pricing of the plan. So they take a look at all the data, they look at all the health insurance applications that are submitted for a group, and they determine what the rate should be. They do all of the policy processing, produce all the plan documents, take care of all that. They offer all the different plan designs that are available, and most of them offer a wide array of different plan designs, including PPOs and HSA plans and HRA plans, even some HMO plans are out there. They offer their full network availability for these MEWAs. They handle all the claims, and these insurance companies also handle the stop loss coverage. So they provide that for these groups as well. So insurance companies are really strong partners. They manage all aspects of the plan, but the MEWA itself is the one that's financially responsible, and they're the ones that are audited every quarter to make sure that they're remaining solvent. So what are these three plans? Let's take a look at them specifically and see what's available. So first one, and actually the one that was out there really before 2015, but then kind of reorganized once these new rules came into play. It's the Council of Smaller Enterprises, or COSE, their acronym, that's what they're known as. This is a firm based in Cleveland. They're part of the Greater Cleveland Partnership, and they partnered with Medical Mutual. So Medical Mutual administers the entire program. Just a couple of plan information specifics. They offer multiple plan designs. They have at least 20 that they offer. And again, everything from PPOs to HSAs to HRAs and HMOs. They offer the full Medical Mutual network, which is excellent in the state of Ohio. So really good plan for Ohio-based groups. They accept groups all the way down to 1 employee, and then they have a maximum of 50 employees. So that's a pretty big deal going down to 1 employee. So basically you could have a group of 1. So you have that sole proprietor that's sitting out there. They're operating, they don't have any employees. They can actually tap into this program and have a group plan that's similar to what they would have if they had 50 employees or 100 employees. They're going to get the same type of benefits that are available, really aggressive pricing, and full networks and all the bells and whistles that come along with that. So really great that we can get all the way down to that group of 1. Any of the plans can add optional dental, vision, life, and disability coverages. And those are, with all of these carriers, they're priced at group rates. So very affordable. Medical Mutual and COSE use a common group effective date of January 1st. So let's say we are talking to a group today and they want to start with this COSE plan effective June 1st of this year. Their very first year would start June 1st of 2020, but their plan would renew January 1st of 2021, along with all of the other plans in the COSE book of business. So all the other small employers, everybody renews on January 1st, and then they would renew on January 1st every year after that. So they try to make all the plans renew at one time. A little chaotic doing that, but it does allow them to evaluate their entire book of business all at once and understand what their rate positioning has to be for the entire group instead of trying to do that piecemeal throughout the year. So all the MEWAs pretty much act that way. In order to get into this plan, a group must join the COSE association. That involves a monthly fee. A monthly fee runs about $4 per employee, per enrolled employee per month. And then depending on where they're located, they might also have to join a Chamber of Commerce. So for example, Franklin County, if any of the groups are located in Franklin County, they have to join the Columbus Chamber in order to get into the COSE plan with Medical Mutual. And that's an arrangement that COSE has negotiated with the Franklin Chamber. So essentially, the Chamber helps them market their plans to Chamber members, and then the Chamber forces them to join. So they give a break on the membership. It's probably about $400, something like that. But you take that in contrast to a group that may be in Delaware County. In Delaware County, there's no arrangement like that. So that group would simply have to join the COSE association. They pay that $4 per enrolled employee per month, and would not have any responsibility to join a chamber at all. So pretty easy to get into this group. And obviously, you know, the affiliation here, as you can see, it's not all just one profession. This is really virtually any small business can join this. Doesn't matter what that small business does, what their concentration is, what their work is. So that's the first one, COSI with Medical Mutual. Second one is the Southern Ohio Chamber Alliance. This started about 2.5, almost 3 years ago. And this is an alliance of local chambers throughout the state of Ohio. It's not just Southern Ohio. There's also all the chambers throughout the state are in here. This is an Anthem administered program. So the Chamber Alliance got together with Anthem and created this SOCA, it's called. And so Anthem, again, administers all aspects of this, multiple plan designs. They probably even have a few more than what Medical Mutual has. They use the full Anthem network, which is great in the state of Ohio, and also extends nationwide. So they tap into the Blue Cross Blue Shield network nationwide. They also accept groups all the way down to one. Now, this is a new thing for them. It actually just started. They used to have a requirement for it to be a 2-person group, but now they've brought that all the way down to one, which is great. So again, it gives us another option for that sole proprietor that's out there and giving them access to a true group plan. Anthem also has the optional dental, vision, life, and disability coverages. And again, all at group rates and very competitively priced. Their common effective date, probably one of the only things I don't like about this plan is their common effective date is May 1st. So again, if I were to be talking to a group and June 1st is their date that they want to start this year, they would have their rates guaranteed all the way to May 1st of next year. They would renew with the entire SOCA book at that time, and then their plan year would always renew on May 1st. The thing that's a little bit troublesome about that is that from an employee perspective, their deductibles still run on a calendar year. So every January, their deductibles start over again. And then on May 1st, there could be a change of rates. You know, they could have a little bit of a rate increase, and you know, they've already started the deductible and it doesn't quite match up with a calendar year. I wish they'd move that, but you know, there are ways to get around it. We work with it, and it's not like it's the end of the world, but it would be a little bit easier if everything kind of aligned with that January 1st, I think. Now, to get into the SOCA program, you have to join a local chamber. And when I say a local chamber, they really do limit it to the smaller chambers. So for instance, if you had a group that was in Franklin County and they belong to the Columbus Chamber, and that's the only chamber they belong to, they can't get into the SOCA world. They would have to join an additional chamber. They'd have to join one that is in one of the smaller communities in Ohio, join that one as well, and that would give them entry into the SOCA world. So Franklin County they just won't recognize that as being part of their alliance. So what we try to do, the group can go to any chamber they want to. There's no stipulation that it has to be the one where they're located. So a lot of times our groups will look at a chamber. So if they're located here in Dublin, sometimes they'll take the Dublin chamber. That runs about $150, $200 a year, somewhere in that range. Some groups will gravitate towards the least expensive chamber there is. So we often will guide people to, here in Central Ohio, the Shawnee Hills chamber. It's only $80 a year. If that's if it's price sensitive for them and they don't use the chamber anyway, that might be something they go do. Downside for that chamber is only open 2 or 3 days a week. So if they're in a rush, they may not be able to get their membership until the door is open. But so essentially they can go anywhere. They join any local chamber. They pay they pay that chamber dues, whatever it might be for that local chamber. And then they pay a monthly fee to the SOCA Association. So that monthly fee, again, is around that $4 per enrolled employee per month. So that's an additional cost. They pay those two things and they get access to these plans. Okay, the last one that I'll talk about is the Ohio Chamber of Commerce. So this is the statewide Ohio Chamber. They have partnered with United Healthcare. This is the most recent MEWA that has been formed. It was formed just about a year ago. And United Healthcare, again, administers the entire program. Multiple plan designs, again, same type of options are available. They use the full United Healthcare network. Again, great in Ohio, and also a nationwide network if they have remote employees. So that works very well. They only accept groups down to 2. So the sole proprietors don't qualify for United Healthcare's plan. They will accept 2, and they also even add in the caveat, they don't let people kind of get around the system. So if you've got a husband and wife who are the only employees, they can't separate and become 2 employees to satisfy that 2. They don't even allow that. So you really have to have a group that has at least 1 employee other than the owner, and have at least 2 people enroll in the plan. And so a little bit more restrictive, but it's still another option for small groups for sure. Again, optional dental, vision, life, and disability. So all those group coverages at group rates are available, and their common group effective date does align with the calendar year, January 1st. And all of their groups renew on that date. For this, it's a very simple thing. You just have to join the Ohio Chamber of Commerce. That's how you get in. So you have to make that membership. There's no monthly fee over and above that. You join the chamber and you're in. So pretty easy access to all 3 of these plans, and they can be very competitive for many groups. So it's a great option. So I'm going to try and summarize all of this so that you can understand a little bit about how it might help your clients. So basically, again, to recap, these MEWAs provide an opportunity for these small businesses to band together as a large group and purchase these really quality group benefit plans. They are highly regulated by the state, so really not all of the trappings that used to be associated with MEWAs. These are really well reserved and very solvent. They're administered by major insurance carriers, so people are really used to working with these plans, and they're also obviously wanting to monitor and keep the integrity and the financial health of these alive, because their names kind of stamped and associated with it. You get multiple plan designs, full network access, all these extra plans, even expanded benefits such as wellness programs and teledoc, all the resources that are available on the insurance carrier websites, like being able to shop for prescription drugs and all the other transparency tools that are out there, being able to use all of those. Virtually anything that the carrier brings to one of their normal groups, you have access to as part of this MEWA. So really dynamic plans that are available. Oh, sorry, I hit the wrong one. I don't know what I did there, sorry. Okay, sorry, I hit the wrong button. Okay, so the eligibility on these, you must prove that you are a documented business. So the MEWA is part of the process to figure out if you can join the MEWA. They may require LLC agreements. They may want to see payroll reports. They want to see tax returns if you're a sole proprietor. They may ask for just about anything just to really verify that, number one, you're a business entity, you're a true business. And they also want to verify that the people that you're going to enroll are truly on your payroll and they are full-time employees. So a lot of documentation goes into to get in. The group must be domiciled in Ohio, so you have to actually have your home office here. You can have some employees in other states. Usually if we see groups with employees elsewhere, we'll gravitate a little bit more towards the Anthem or United Healthcare plans. They tend to have better networks outside of Ohio. Medical Mutual can accommodate other employees, but they're using kind of a patchwork of networks that sometimes doesn't work very well. But bottom line is, you may have a group of 10 employees and they have a couple of salespeople in other states. They would still qualify for an Ohio-based MEWA. Again, groups from 1 to 50 employees can qualify for these. The groups are fully underwritten. So again, younger, healthier groups, they're the ones that tend to receive the most competitive offers. So when you have, especially when there's a small group of 1 or 2 people, if you have someone that's got a really serious medical condition, these may not work very well. Because the insurance company is going to rate accordingly. And sometimes their rates will be higher than what you could get by going to the exchange and going to a community rated plan. So it may not work very well for smaller groups that have problems. But groups with normal health or even, some kind of chronic illnesses that just aren't, really a big problem. You get people with high blood pressure that's controlled by medication, things like that. That's really not going to affect very much the premium. So really, you don't know until you go through this whole process. We can never tell until they go through the entire underwriting process. But it's a pretty simple deal. What they do is they use one online medical application, and it's used by all MEWAs. Also, coincidentally, it's used by those companies I talked about that have the small self-insured plans. So when we go to a group, we will tell them that here, we need all of your employees to go online, fill out, answer these medical questions, and then we take that and bundle it and send it to everybody. So we're able to get quotes from all of the MEWA organizations. We get it from all of the self-funded plans. And then you can just really see, are any of these going to be a viable option? But it really is easy for the employer. They fill out the one online application and then they're done. And all of these groups, they don't have to join the MEWA until they say, hey, I really want to move forward with this quote. So they don't have to join just to get the quote. The MEWA will quote everybody that comes to the table. And then after the fact, if the group says, yeah, I want to proceed, then they will have to either go join the chamber, they'll have to pay their association dues, do whatever is required of them to go ahead and then become part of the MEWA. So pretty easy process. So finally, really want to talk a little bit about who might benefit from these plans. And this is where, you and working with your group clients, this is probably the most important screen on here. So first, current business owners. So if you're dealing with the small business owners and they're complaining about the expense of their health insurance and having limited options that are out there, and they're in a community rated plan, or maybe they're even in a grandmother plan that is really just increased in price for a long time. Those business owners just need to know that there are other things out there. They can take a look at these MEWAs. They can go directly to the SOCA site or the COSI site or the Ohio Chamber site. They can get quotes just by going directly to those entities right away. They can work with a local consultant to go ahead and do all the shopping for them. There are a lot of different ways for them to get to these plans. Just kind of important, I think, to let them know that they are out there. Second thing that we're finding as a market is the early retiree market. So when I spoke with you guys last time, a couple years ago, that was my topic, really talking about how to find health insurance for early retirees. So many times what we find is that a person retires, but they still might want to do something. They still may start a new business, or maybe they had a new small business that they were already running on the side. They might look at going into the MEWA world as an alternative to COBRA, or as an alternative to go into the individual marketplace. So they might be that, they might want to be a consultant, and they just hang out their shingle, and it's just they're the only employee. They might be maybe running a small online business. Maybe they're even, they have an LLC that owns apartment buildings or owns other investment properties. Any one of those types of business entities we can attach to the MEWA program and use that as the vehicle to find other alternatives for their health insurance. So really great for that employee and early retiree market. assuming they do have another business that they're going to continue. And then lastly, some of these small business owners, whether they're early retirees or not, that are looking to keep their coverage in place after age 65. If you're in a community rated plan, you don't have that option. The community rated plan, once you get to age 65, you must get off those plans and go over to Medicare. So under this world, the MEWAs allow people to stay on the plan as an alternative to Medicare. And so people that reach age 65, there may be reasons that they want to do that. Maybe they don't like Medicare for whatever reason, just don't want to be on those plans. Maybe it's an expense issue, or maybe they're in a high deductible medical plan today and they want to continue contributing to a health savings account. As long as they have a high deductible medical plan in their MEWA, they can continue to do that. Of course, they can't enroll in any part of Medicare if they want to do that, but it is another vehicle for those people that are over age 65 to continue to have a group plan as opposed to being forced into the Medicare world. If they stay on these plans, they can eventually move over to Medicare and not have any problems with late enrollee charges or anything like that. These plans are all, as long as they choose the right plan, they're all compatible with Medicare and creditable, and so they're not going to have any issues with that whatsoever. So that's really, give you a lot of high level information about what these plans are all about and how they're structured. Don't expect you to really know all the ins and outs of the self-funding mechanisms and all the plans that are out there, but this is really something that you could take back, and when you're talking with your clients, at least be able to inform them that there are other alternatives out there, and these are the types of categories of people that could really benefit from just at least taking a look at some of these plans. So with that, I have finished the presentation. I am very happy to answer any questions that you may have.
Do you see in the chat the question that I sent over?
I probably have to get out of my presentation here. I'm sorry.
Oh, maybe so.
Maybe stop sharing my screen. Okay.
We have a question from Phil Ratcliffe. It went to everyone, and I sent it to you so you'd see it too. And then anyone else post any questions here.
Where would I find that question, Debbie Lee? I'm sorry.
And if you click on the chat at the bottom, I can read it to you. It says, did you see, are these plans less expensive than buying individual coverage and then helping EEs through QSE HRA or ICHRA? I don't know what that means.
Okay, yeah, so that's been something that's happened a little bit in our world too, because essentially some legislation was passed that allowed employers to form an HRA, and that HRA, they would basically be giving a pot of money to all of their employees in lieu of providing health insurance for them. And then they allow the employee to go out and use that money to purchase health insurance. And so I believe, if I understand the question and the intent, from a business owner standpoint, would it be cheaper to do that? And it really would depend on how much the employer is funding. So the employer may decide to fund that HRA. They have to make it meaningful. So that HRA, I've seen numbers out there, people will fund it at $1,000 a year or whatever. So they could take that same $1,000 and make that an employer contribution towards health insurance. And the bottom line is, depending on the group makeup, the actual insurance itself could be, and probably is, much less expensive than what that employee is finding out in the exchange, because that's probably where they're going to get their coverage. And so the insurance product itself overall for all employees in most cases would be cheaper. And the employer, are you giving money in an HRA, or are you doing it through employer contributions towards the health insurance plan? It's really up to the employer. I think there's another thing that comes into play. I think when you're out there attracting employees, most of them are expecting them to offer some sort of health plan and not force me to go out and find my own. May work out great for some people who are on their spouse's plan, but people who don't have any insurance at all, now they're forced to go out into the world and find coverage and you know, navigating the individual marketplace, and some of the plans that are out there is just not always that fun. So it's going to be a different answer for every employer. It's one of those things that they really need to take a look at all of the different aspects, and there's a cost factor, there's a corporate culture factor, all those things come into play.
Thank you. I don't see if anyone has a question to put into chat. I'm not seeing any. So, last chance. All right. Well, that was really interesting. I learned a lot. I usually don't get to hear them, so I personally enjoyed this. You did a great job, Ron. Thank you so very much. Oh, wait, there's a question. What % on average do you find in savings from MEWA compared to community plans? Again,
Okay,
from Phil.
good question. And again, it varies all over the place. It's going to be based on the health. So if we had a really healthy group, we could see 40 to 50% lower premium easily. I had one group that I moved a couple of years ago. They were actually on, wasn't a community rated plan, but they were on a grandmother plan. They had been on it for a long time. And we cut their premium. It was a group of about 25, 30 employees. They saved $100,000 on their premium by moving over to the MEWA plan. So that was about a 40% decrease over where they were even on a grandmother plan. And the community rated plan was even more expensive than where they were grandmother wise. So again, it depends on the health of the group. So you get the groups that have poor experience, they have, you know, some chronic illnesses going on, things like that. They're going to be, everything's underwritten, so they may not get the best rate, but groups that are at least reasonably healthy, you're going to see a significant decrease over what the community rated plans look like.
Thank you. And a reminder too that we'll post the PDF of the presentation with your permission. Ron, I think we have that.
Yep, absolutely.
So that'll be posted under our past events, so you can reference that information. And then I think now we're ready to close the meeting, and hopefully everyone who needed insurance saw the poll questions and got those answered. I won't be able to see that until after I close the meeting. And watch for future events. We're still working on symposium, and whether it's in person or a hybrid event, we're going to make it work. And we're still working on this. I think this went pretty well. So thank you all very much. Thank you to Ron. Thank you to Jeff. Thank you to all of you. Have a great Tuesday. All right.
Bye-bye.
Bye.